Hi, I'm Keith Richards, Portfolio Manager, Value Trend Wealth Management of WorldSource Securities, and welcome to our video for this day, June 11th, 2015. And we're going to today take a look at the S&P 500, and we're going to compare a pattern that took place during the summer of 2011 that eventually led into a 21% correction. Now, here in June of 2015, we have not had a 20% plus correction. In fact, we've not really had many corrections over 10% since that date. So that alone makes me wonder if its time is due. But let's see if there's a couple of patterns that are occurring on the market that may just repeat themselves from a couple of different angles. So we'll get right to the charts. This is a chart of the S&P 500 that you have in front of you here, and it's from the beginning to the end of the year 2011. And you can see I've drawn a trend line on the rising peaks and troughs that began basically in February of that year and ended in June. Now you can see it was a bit of a rough pattern, but nevertheless one could still define it as a bullish pattern. So sometimes when you get an awkward angle like this, people will call these patterns rising wedges. I'm really hesitant to name anything a rising wedge because, quite frankly, they're a little hard to identify. But call it what you will. There was a rising pattern, but it got a little bit rough. And you can see in June of 2011, the market sold off. This is fairly typical. June can be, from our seasonal friends who do this monthly type of analysis of the seasonal patterns, June can be a bit of a weaker month. So true to form, the month of June sold off on the S&P 500, but July ended up with a nice recovery rally, and that might have been a little bit of a head fake to investors because along came the problems in Greece and Italy, and whether the Fed would stimulate again here in North America. I don't know if any of these worries are abounding right now, but it does sound a little familiar. We're all worried about interest rates. We're all worried about Greece. So I think conditions were relatively somewhat similar. And sure enough, after the July rally, we saw a great fallout, and that resulted in our 21% drawdown from the peak in May, actually. So let's take a look now at current market patterns, and then after we look at this chart, we're going to look at some sentiment, and I think you'll find this quite interesting. So the current market pattern, really, which has been in place since the beginning of the year, again, if you want to call this a rising wedge, have fun doing so. I'm just noting that it has been a series of rising highs that seem to be squeezing a bit. That's typically what some people call a rising wedge. It has been a fairly neat and tidy uptrend line. And in fact, here we are in June, and we're starting to see a bit of weakness. Now, past couple of days, we've recovered after a sell-off, but there does seem to be some break of this prior trend line, and perhaps that's a sign of June weakness. Now let's take a look at some of the other factors that were in place in 2011 and see if we can compare those conditions, so beyond the chart patterns. And this is analysis done by www.sentimenttrader.com. As you can see the name in the top right-hand corner of the page here. I am a subscriber to their research, and I highly recommend their research to any budding technical analyst who has interest in sentiment studies. I can tell you it has aided me enormously in my trading decisions, and in fact, anybody who knows me knows that when I wrote my thesis for my CMT designation, my Chartered Market Technician designation, I wrote the thesis on sentiment. So I'm a big fan of this stuff, and these guys are probably the premier providers of a lot of different sentiment studies. So this is my favorite that we have in front of us here, and it's the ratio of equity purchases, equity fund purchases versus money market fund purchases in the United States. And what's really interesting here is that this tells us what the retail money, and I hate to say it, but the dumb money is doing as far as how bullish or bearish they are. So if they're piling into equities and selling their money market funds, this blue line goes up. Reverse is true when they're selling out of their equities and buying money market funds because they're scared. Well, as we know, retail / dumb money is usually bullish at the wrong time and bearish at the wrong time as well. And this chart really does demonstrate that, because here we have the great peak of 2000, And what were they doing? The retail investors, they were buying equity funds hand over fist and had no interest in money market funds. Heck, why would they accept a few measly percentage points when they can become rich overnight on tech stocks? You can say that didn't work out so well. And of course, when the market bottomed a couple years later, they were out of their equity funds and buying money market funds. And so the ratio decreased. And you can see that was an excellent time to be buying. So on and on we go. We see the period leading up to the 2007-2008 peak was led by good old retail investors buying their mutual funds, equity mutual funds, and bailing out of their money market funds. And sure enough, that led us into a pretty hefty correction, as we probably all remember, in 2008-2009. Now look what happened at the bottom of that crash, March of 2009. The equity retail investors were not buying their equity funds. In fact, they were bailing out and buying money market funds. So let's take a look at case in point of 2011. You can see this is 2011 right here. Retail investors were once again piling back into their equity funds, selling their money market funds to a certain degree anyways. And as you can see at the top of the chart, on a grand scale of things, it wasn't as big as the last crashes, but it was a 20% correction. You can see that on the S&P 500 here. So where are we today? Well, gosh and by golly, we have the retail investors participating in equity through equity mutual funds on a larger scale than literally they ever have. And if this doesn't bother you, I have some swampland in Florida that I would just love to sell you. So tongue in cheek. So let's go to margin debt, also a chart by Sentiment Trader, and you can see member firms, they lend investors money on margin to buy stocks, and you can see this again usually occurs near market peaks. And of course, margin lending decreases at market bottoms. So we can see that most definitely happened in 2007. In fact, if I bring the chart back to go back to 2001 and whatnot, you can see margin increased right near the peak, decreased right near the trough. We're going to look at 2011. You can see there was a definite margin peak back then. And of course, that led into a sell-off on the market. And once again, when the market had finished bottoming, retail investors lowered their margins, lowered their debt to buy stocks, and that would have been an excellent time to buy. Where are we right now? Well, once again, we're at record highs on margin debt. By the way, the reciprocal to that is amount of cash available that the member firms have to lend, and that is at a record low level right now, which makes sense. So all of these signs suggest to me, between the patterns that we're seeing, the seasonal factors, and some of the debt and equity to money market flows that we are seeing, that things are getting a little heady. And we're probably not due a great crash, but we may very well be due a correction of 10 to 20%. I think that's going to happen sooner rather than later. It's very hard to put your finger on the calendar and pick the day it's going to happen, but I think the signs are there that there's at least a probability of that happening sometime over the coming months. Thanks for watching.